Hello, this is Alan at Alan Talks FinTech. Today I'd like to talk to you about finding a 10-bagger, which is a stock that rises 10 times more than what you paid for it. So what is a 10-bagger? This term was made famous by Peter Lynch, who was a fund manager at the Magellan fund at Fidelity. Peter was famous for outperforming the rest of Wall Street, and when he was managing the Magellan fund for about 13 years, the fund gained over 29% on an annual basis. He did this by buying what you know. He'd often observe what his wife was buying or what was popular around him, like Dunkin' Donuts, and then he would buy these stocks, and a lot of them would gain 10 times over what he paid for them. So he referred to those as 10-baggers. And that term came from baseball. Peter, coming from Boston, probably went to the Boston Red Sox games a lot. And a 10-bagger in baseball is a player within a game who reached a base at least 10 times. So like if you hit 2 home runs and a double, you would have touched 10 bases within the game, and that's good. That's a good day for a baseball player. So for a fund manager, getting 10 times what you paid for a stock is really good, and Peter said that's a good way to improve the performance of any fund. But what about us? Can we find a 10-bagger? Will we be able to find a stock that we pay a certain price for and then it gains 10 times what we paid for it? If we go to Amazon.com, look up Peter Lynch's book, One Up on Wall Street, you can see that it sold over 1 million copies. Really popular book, and it's probably one of the classic books of all time in investing. So how do you find a 10-bagger? The way Peter did it, he looked around him. He saw what his wife was buying. He saw what other people were buying, and then he invested in those companies. So some of the stocks that he's famous for buying, Starbucks, Dunkin' Donuts, Taco Bell, when you see those things today, you think, yeah, sure. But back then, he was observing those companies as they were just starting out. He was observing how people were buying products for those companies on a frequent basis, and then he invested in them. So a lot of those are kind of staring you in the face, but we may not think to invest in them, or we may catch them too late. So how do you find a company that's early in its life cycle that may gain 10 times after you buy it? So I want to tell you a couple examples that I've dealt with in my short investing career. A couple years ago, I noticed the company called Square. And the reason I noticed it, I went to a little cafe, and they were using Square at the checkout, and I was like, I wonder if that's going to become more popular. And then I saw other people using it with their smartphones. It had a little adapter that you plug in a smartphone jack, and you could take payments with credit cards. So about that time when I first started noticing it, it was about $12 to $14 a share. I bought several hundred shares, and even though at the time they were losing money, they were progressing fairly well as far as heading towards making a profit. Also learned that Square was started by Jack Dorsey from Twitter. I thought it'd be a good deal. So I hung on to the stock. It kept going up, got to about $40, and then I ended up selling it. I thought, well, it's not going to go up much more than that. I'll just sell it. But not too long ago, Square hit around $100 a share in September, and it kind of settled back down in the $50 range in December. And then back in March, it was back up to around $70, $77, and it's been kind of in that range ever since. Now, what if I'd hung on to those shares that I originally bought then I would have probably made anywhere from 5 to 8 times what I originally paid for them over 2 years. So there's another stock, Roku, that IPO'd a couple years ago at $14 a share. And I noticed that about day two, the stock price was going up. It was about $18. So I bought I bought 500 shares at $18, and then it kept going up. It went up to about $30 and then started coming back down. And when it got to about 24, I sold off about 400 shares and hung on to 100. So I made profit on those 400 shares, and then it kind of kept going back down, and then it hit 18, and I sold the remaining 100 shares. And since then, it's gone back up into the 70s. I think recently it's come back down into the 50s again. But if I'd hung on to it, I probably could have got 5 times what I paid for it, or at least 4 times what I paid for it. So not quite a 10 bagger, but that's one of those stocks that, if you're just patient with. So kind of the moral of the story is when you buy something like that, and if it's truly a good company, it will bounce around a lot in terms of price, but it'll continue to gain value and stock market price over the years. So my advice would be buy early, hang on to it, and just wait it out. There may be some phase in its life cycle where it kind of plateaus out. It'll slow down a little bit in terms of its growth, but if it's truly good stock, it'll keep going. Peter Lynch's advice is to look for companies that aren't in the spotlight, but they have steady growth. And they're probably going to end up being companies that produce something that either people or companies go back to and buy again. So repetitive purchases or repetitive use. They're probably smaller companies. Their executives buy their stock. They're less than $100 a share, but definitely not penny stocks. Kind of look at their capitalization, their growth, their PE ratios. Look for 20% growth a year. So that was Peter Lynch's advice. So you're looking for 10 baggers. You think you found a company or companies that you should invest in for the long term. So how much do you spend? Well, be nice if you could just take $100,000, go buy a stock, hope it goes up 10 times, and then you'd have $1 million. But that's kind of risky. It's hard to put $100,000 unless you're a fund manager into a stock. So maybe you think of it a different way. Maybe you look for 5 companies and you put $20,000 each in them and you spread out the risk. And so if you lose money, it's not a big chunk of your savings, even though $20,000 may be a lot for some people. So kind of what I'm doing now, I'm focusing a lot on dividend stocks, probably putting about 75% of my money into dividend stocks. And then the other 25%, I'm looking for potential 10 baggers. That way, 3/4 of my money's safe. I can do this because, I got another 5 or 10 years before I retire. If I were going to retire in the next couple years, I'd probably just stick with the dividend stocks. So what I'm going to do is probably take about $20,000 chunks, try to find companies that are gaining or have the potential to gain over the next, say 5 years, put my money in those. So where do you look for the 10 bagger? Well, it helps if you look in areas that you know and you understand. I'm in the computer industry, so I see a lot of computer related or IT related stocks. So one of the things I've been noticing lately is my company and a lot of other companies in the financial industry, medical industry, tech industry, they're moving to the cloud. So instead of building custom apps, they're buying apps like Salesforce, Workday, ServiceNow. So those are replacing applications from older companies like HP or PeopleSoft, or apps that they built themselves. So one thing about these cloud-based companies, as companies are migrating to them, they're almost too big to fail in a way, because companies are going all in. They're moving all their HR functionality into Workday. They're moving their contact management stuff into Salesforce. It takes a long time to migrate into those cloud-based packages and away from their older packages. So they're going to stay with them for quite a while. So in that way, there's kind of a moat built in with these companies. Now, one thing to keep in mind is that some of these cloud-based companies could be bought by other bigger companies like IBM. So IBM has cash, they'll go out and buy companies. Recently, IBM bought Red Hat, is kind of an example. So I know another example. I know one person who bought biotech companies in the late 1980s, held on to them for many years. They were purchased around $1 a share, and now they're over $200 a share, and they split many times along the way. So this is an example of holding them 20 to 30 years, and they gained a lot more than 10. They gained 100 or 200 times what they paid. Now, there's a lot of biotech companies out there, so which ones do you buy? I'm not really into buying retail consumer discretionary stocks. Seem like the retail business is kind of fickle. They're here today, gone tomorrow. Unless you can find one like Walmart or maybe like Target or Starbucks or some company where there's kind of an addiction like coffee. And you got to look at what keeps them coming back to repurchase at those companies. If you can find a new company like that where people keep going back to, that's probably a good investment. Now, here's an interesting thing. I originally wrote an article about this 10-bagger approach on my website, alantalksfintech.com. And then shortly after that, I noticed Jim Cramer had a segment on Mad Money about stocks that he wished he had bought. He called it his woulda, shoulda, coulda portfolio. So here's some of the things that he wished he could have bought or should have bought. Eli Lilly, Twilio. Now Twilio keeps going up. Same way with Intuit, Etsy, Roku, Boeing, Workday, ServiceNow, Splunk, and VMware. So a lot of those are cloud-based companies or tech companies, and a lot of them are growing, mainly because companies are buying their software or buying their services, and kind of there is a moat around some of them. So here's some technology companies I know about and have looked at. So Guidewire is the first one. Guidewire produces insurance package applications, and a lot of insurance companies are replacing their custom-built insurance apps with Guidewire. Workday. Workday is another cloud-based company. A lot of companies are replacing their HR functions. They're swapping out PeopleSoft and replacing it with Workday. Salesforce. Salesforce has been around quite a while. A lot of companies are putting their customer relationship management information in Salesforce. ServiceNow. So ServiceNow is another one that have been replacing Hewlett-Packard's system management packages, and it's cloud-based, and a lot of companies are switching over to ServiceNow. New Relic is also another system management company. It's a little bit more around monitoring and alerting, rather than with ServiceNow is more about ticketing and management. And then the last one on the list, Splunk. I remember when Splunk came in to demo their product, it basically, they were selling it as a way to take log files on computer systems, pull them into a central place, index them, and allow you to search through those logs. And then they've added a lot of capability for producing reports and dashboards and things like that. So I went back and took a look at some of these companies over the last, 5 to 8 years, and look to see how much growth they've had over those years. So let's take a look at some of those. So Guidewire, if you go back and you look up their stock price history. Goes back about 8 years, and over those 8 years, they've gone up 372%. Workday, go back about 7 years, about 250%. Salesforce, go back 8 years, over 400%. Now look at ServiceNow, over 7 years, it's gone up 689%. New Relic is more of a newcomer, so in 5 years, it's gone up about 240%. Splunk has also been around for a while, but their growth's been more recently. So they in 7 years they've gone up 275%. Palo Alto Networks, which a lot of companies use as kind of a firewall or an intelligent firewall kind of technology. So over the last 7 years, it's gone up 300%. So Atlassian is another company, stock symbol TEAM. They have a product called Jira. They haven't been around as long. 4 years, they've gone up 360%. Microsoft, in the last 7 years, has gone up about 240%. And then here's one that really surprises me a lot, MongoDB. So MongoDB's been around for a while, but they recently IPO'd within the last 2 years. They've gone up a lot, over 200% in 2 years. Now, if you go look at a lot of mutual funds that have grown a lot, or hedge funds, you'll find MongoDB as one of the stocks that they bought. So those companies kind of driven up the price. They're still losing money, but price is going up. And then the last one I put on there was Square. You go back 4 years, up 700%. So as we take a look at some of these stocks, what does it kind of tell you? A couple things I take away from this is I think you have to be patient when you buy stocks that you think are going to grow. So you got to be patient and see them through. It may take 5 to 10 years for some of these stocks to go up 10 times. So you got to stick with it. The other thing, I think you have to really be quite observant. Try to catch it early. So a lot of those companies I was talking about, I've seen those companies come into the IT industry pretty early. I knew about them, but I didn't really investigate their stocks. I didn't invest in them, and it's only been recently that I really started looking at it like, whoa, what would have happened if I had bought that earlier? How much would it have gained, and if I'd stuck with it? So I'm trying to be a lot more observant now, trying to, pay attention more. So here's a question to you. What stocks are you seeing out there that could be a 10-bagger or maybe a 5-bagger? So I'd like to hear your comments. So in the comments below, let us know of any stock that you think has potential of growing 5 to 10 times over the next couple years, and maybe over 5 years. And also, if this video helps you, hit subscribe, hit the like button, and take a look at my website. I'll put a link in the description, and you can read the articles in there and make comments in there. Alright, thanks again. This is Alan. See you next time.